It's Thursday, the 17th today, and it's 11:30. So here we are with episode 63. It's going to be an amazing video. My name is Sam Thompson, and I'm joined today with Joe Bladek. How are you doing today, Joe?
Hey, Sam, not bad. And thank you for the introduction. Yes, it's the 17th, and glad to be here today on Canadian Mortgage Weekly and getting into today. I mean, we're getting closer to the spring. I know that the weather out there is a little warmer today. I see a lot of things melting, and we've had some rain overnight. So that's been a nice little change since all that cold we've been having. And how are you doing today, Sam?
Yeah, that's right. I'm doing good. It's definitely been funny weather-wise, right? Yesterday was quite mild, and then I'm seeing reports that I think over today into tomorrow there's supposed to be, some messy weather down in the Toronto region. They've had quite a winter this year. But yeah, definitely crazy that we're already at the 17th of February. I mean, February has flown by so far.
It really has flown by. And, we see a lot of our home buyers even saying that too. Like, things have been going so fast with the housing market, the mortgage market. There's a lot of news flying around. And I know that a lot of people are, just seeing this market go really quickly. Houses are selling really fast and way over list. So it's just a crazy market and a lot of news out there.
Yeah, that's right. I mean, I've noticed on the most recent walks I've been having with the milder weather, I'm seeing a lot more for sale signs or even some
Yes.
coming soon signs. So, I know we're still working on very limited inventory, but it's spring, which means people are itchy to move. Maybe they're, looking at putting their house up to see what it's worth in today's market.
Exactly. And when you mention taking a walk around the neighborhood and how that's all been going, I do the same thing. And I've been seeing that too, Sam. And as you remember, I was even showing you this morning, there was a house that I walked by last week. It was for sale, I think around 900,000, 899. And I was thinking, wow, that house last year would have sold probably for 600,000 or 700,000. And then just today it sold for over $1 million. And I cannot believe that. That's in Aurelia. And it's just nuts. But yeah, a lot more listings are popping on the market, which is really good to see because inventory has been at record lows. And we do need those listings there to be able to continue being able to see people buy more houses.
Yeah, absolutely. I mean, I feel like it's been the same song and dance from realtors the last while of inventory is the issue, inventory is the issue. And I know, in some regions, sorry, we're, under a month's supply of housing. So everybody's quite strapped. So if you're watching this and you're considering selling, put it on the market, help all of our first-time buyers steady out the market a little bit better.
Exactly. Yeah. And with our first time home buyers, I know that there's a lot of, challenges right now that they are seeing, with first time buyers just trying to get into the market. A lot of first time buyers are doing everything right. They both have a full-time job. They have savings. They have no debt. They have no car loans. They have good incomes. And it's really challenging to get in the market. So I know that we have a special episode planned for next week for that, which we'll get into later. But for today, let's get into some of these stats and give some updates as to where we are at with the mortgage stats today.
Yeah, absolutely. I'll go ahead and start the presentation as we look first at what the bond yield has been doing for the 5-year the 5-year bond yield. And you're seeing there on the chart, on the graph, sorry, that we've had a few peaks, and those peaks actually brought us to, over 1.8%. Currently today we're at 1.77, so you do see that small dip, but the fact that we were able to break 1.8 is maybe some indication of what's coming in the future. I know that, we track this each week. We've been watching, where the thresholds are to see what range it's in. And yeah, given that we broke that mark, could be an indication for the future.
I think so too, Sam. Yeah, we were watching that trend line, and there was some resistance there that bond yield was approaching, and breaking through that, we could see the the rates trending upwards from this point forward with that. And we've been seeing that looks like since September of 2021 at this point. We did have that small dip over the Christmas holidays, New Year's holidays break there, but you're right, we are seeing it trending upwards. And we've seen our lenders in turn provide us with rate increase notices almost on a daily basis right now. It seems like we're getting a lender increase here, a lender increase there. So they're really following suit with this bond yield. So for any of you that are watching that are looking to either lock in your mortgage rate or to set up a new 5-year fixed rate, know that every day you wait at this point will can actually cost you a few more dollars in interest down the road, because we're seeing folks lock in for much lower rates now than potentially we could see in 2 or 3 weeks.
Yeah, absolutely. And it's definitely a call as well. If you're hoping to get into the market as a first-time buyer, but maybe need a month or two to sort things out, getting that pre-approval with the rate hold certificate can help you. Of course, it may not look exactly like the lowest rate of today, but it could protect you in the event we're seeing these rates keep rising. So it's a smart option to do because it guarantees your rate for 4 months, which might give you some time to shift around some of that money and prep yourself in a better position to buy.
It definitely does. Yeah. The pre-approval certificate, locking in your rate for 4 months is a very smart move, especially if you're looking to get in the market. Just it gives you that security knowing where your payments will be at going forward. So looking at the next stat, we have the CDOR rate. I know, Sam, we've been following this on Canadian Mortgage Weekly for quite some time now, and it's a good indication of where variable rates are at, if they are a good deal, if they are not a good deal. And I see here that the rate has significantly changed in the last few meetings that we've had.
It definitely has. I mean, even looking, on the stats for January 14th of this same year, so almost a month ago, it was at 0.47, and now we're all the way up to 0.62%. So again, what this is indicating is, we look at it in regards to a variance from prime, which is 2.45. And right now we're still seeing that it is over that prime mark, meaning that, we'll have to see what happens at the Bank of Canada interest rate announcement, but it does give us some indication that we might see that variable rate increase at the next, rate announcement. And, it's an interesting metric to look at, the CDOR rate, because I feel like that's where we saw a lot of shift over the COVID market, where last year, 1/3 of Canadians were into variable rate mortgages, and now that's dropped to 1/5 at the start of this year. So it's an interesting metric to track to see, what camp you want to be in terms of fixed or variable.
So we'll continue to track this metric going forward. And you're right, looking into the next Bank of Canada meeting, that is coming up March the 2nd of 2022. So in advance of that, the CDOR rate has been moving. So maybe that is a show of what is to come. We did not really see a move this much before the last rate meeting. So perhaps it moving so aggressively now is really what's going to be coming on March the 2nd. And March the 2nd, that's more spring 2022, which is more on par with the original announcement of when rates were going to go up, and that was in spring. So right now, Bank of Canada's rate is at 0.25%. I can't believe it's held here since March of 2020, but this is a rate that was Bank of Canada did drop the rate to 0.25% because of the COVID crisis. So it would almost make sense that if COVID is ending its leg with Canada right now, that we would see a rate increase very shortly.
Yeah, I mean, that's right. And it's definitely, anybody who took that jump into variable in March 2020 has been sitting very comfortably for the last 2 years. But as we were saying, even the first rate announcement of the year, there was a lot of, media articles, economists that were claiming there would be a rate hike. But because we didn't see it, it does put a bit of, pressure, or I guess just, more excitement in watching the next rate announcement, where we're likely going to see a rate increase. Um, but again, we'll keep you posted on March 2nd with a special pre-rate announcement show, where Joe and I will talk about, some of the articles or economists that we're seeing leading onto the event with the live announcement just after 10. On, I think that's about 2 weeks from now. So join us for that. It'll be exciting to see what happens.
Well, and I'm really looking forward to it because it's always exciting to see what the Bank of Canada is going to come out with. For us, at least as mortgage professionals, that's sort of what keeps our excitement at its highest for what we're into. So really looking forward to seeing what comes out of the Bank of Canada on March the 2nd.
Mm-hmm.
But going forward, we have another really awesome stat to share with everyone. Sam, I know that you had found that it was released. Tell us all about it.
Yes, the next stat, which we just got released this week, was the national house price average, where we see that quite a steep incline. We had seen some gradual curves on the graph here, but for January 2022, the national house average had jumped to $748,450, which is a substantial amount for sure.
I mean, that is a new record as well. We saw the prior record set there a few months ago, and now this is a new high that we've just hit. So I don't know if we should celebrate that in Canada or not, but it seems like a double-edged sword. It's great for some people, it's bad for some people, but here we are. And with that national house price average, to afford a home like this in Canada, you do need a substantial income at this point. An annual household income of about $156,000 would be required to afford a home in this price range. So that is quite an income. And what are we sitting at year over year today, Sam?
Yes, year over year is an incredible stat. As we were looking at December was the most recent data we had, and I think December 2020 to December 2021, we were seeing an increase of about 17%. But looking at January of last year to January of this year, we're seeing an increase of 21.9%. Which is huge, especially, if, like you're saying, there's a couple different groups that are affected by this. And if you're somebody who's camping in your forever home, that you're not moving, maybe you'll love Aurelia so much that you aren't going to move. That type of appreciation is definitely good news, because that's that third income of your home appreciating year over year. But again, it does put stress on new buyers. As a lot of clients that we chat with, they're unsure about where the market's headed. Should I go in now? Should I wait? But if you see, if you were planning on buying last year and thought, let's wait a year, pay down some debt, maybe add some extra down payment in our savings, but now you're seeing all the house prices are up 22%. So it should be an indication of maybe a call to action, or something's got to give, right?
One of those two for sure. However, where we're at right now, the high national house price, we still have low inventory, and we are seeing a lot of foreign investment, and that's for another episode. However, the increase of 21%, you're right, Sam, it will put into perspective a lot of goals that people have had. Maybe we should wait. But at the same time, maybe we shouldn't wait, because maybe waiting can cost more.
That's right.
Yeah.
Yes.
Yeah. Anyway, that was great to go over those metrics today on Canadian Mortgage Weekly. And as we finish those off, we're going to get into our topic for today, which is extended borrowing solutions. And extended borrowing solutions are really key today, especially with this national house price as high as it is. We're seeing a lot of folks that have good incomes and good savings just not be able to qualify for even the average price home. So let's take a look at some of these average prices and extended borrowing solutions that are available.
Yeah, of course. So starting off to give everybody a baseline, we just have what it would look like with a prime rate lender. So we're seeing a household income, for example, a at the blue bank here of a standard income 145,000. You might need to bump that up. If you check out last week's episode, we looked at a lot of different creative incomes. Maybe you're somebody who's wanted to start a side hustle, and you can find out how you can use that income to help you qualify for a bit more. But in this case, we're using a general house income of 145,000 with some standard debt amounts, 27,000. In my example I was doing up, that was between a car loan, some balance on line of credit, as well as some student loans. And we're seeing that that's maxing their amount purchase wise at about $780,000.
Right. Yes. And with that max amount, we're getting right close to that average house price. It's a very good rate. However, maybe it's really hard to find a house in your market for 780,000, and perhaps this could be a starter home in your market, and you need to look at an extended borrowing solution. Is there something available for me where I can afford more of a mortgage? Because we are seeing that this in a lot of markets is sort of the starting line at this point and not the average line, unfortunately. I can't believe it, Sam. I know we were just talking about it a few moments ago, that when just 10 years ago in the mortgage industry, the average house price was 500,000 in Toronto, where it was the highest. But here we are, we're looking at it's higher than that across Canada. So this would be with a prime rate lender. This is rates that you can get that are the best rates currently. However, prime rate lenders where you can get the best rates are not typically the lenders that clients would want to approach if you're looking for a solution that would allow you to borrow additional funds, quite often putting you in a different category for a home. So looking at that next category, you can have that on the screen there. Looking at the Green Bank, for example, same income, same debts, which is fairly standard, 27,500. The max purchase price would go from 780,000 to 860,000. Also, your max mortgage would go from 624,000 to 688,000. Now, in trade-off to have this happen would be a slightly higher interest rate by about 0.15%, which would translate to a slightly higher monthly payment. However, it does get you into that market.
Yeah, that's right. I mean, even as positive as the blue bank looks, its max purchase price is around the average. I mean, you were even talking about the house that you had seen in Aurelia list for $899, and it sold for over $1 million. So even a national average of 748 doesn't necessarily mean the sale price. So by using these extended borrowing ratios, paying a slightly higher rate, it's only about $400 a month more for this extended ratio. It does give you an increase of about 9.75%, so almost 10% more buying power, which like we're saying, in today's market, definitely there is a need for that, depending on what you're looking for and what you require in a home.
Exactly, Sam. Another good thing is that when you're trying to obtain and secure a mortgage on your own, to be able to dig out these borrowing solutions, it's going to be quite tedious. You're going to have to go to each lender yourself and figure all this out on your own. Whereas with a broker, we can actually place you with all these lenders and pre-qualify you across all these lenders with one stop and with one sort of one-stop shopping. But looking at the third solution, if a 9.75% increase is not good enough for you, you really want to up your borrowing power, then as mortgage professionals, Sam and I do have options with other alternative lenders, which for that same income of 145,000 and the same debt load of 27,500, that person that with the blue bank could afford 780,000 could turn around and afford 1.15 million with a different bank. Rate is a little bit higher, Sam, 3.99. So we are looking at a little bit of a higher rate, but wow, what an increase.
It's a huge increase, 38.34% is, very, very substantial when you're looking at the exactly like you're saying, your initial qualification with a typical prime rate lender. So this again, like you're saying, is maybe, you want to stretch yourself into a more luxurious society. You want all of the amenities and then some, but you don't want to have to increase your income or pay down any of those debts. So this solution is available for you. It would have to likely be an extreme case, I would assume, for a borrower to want to stretch to this amount. But keeping in mind, this is a maximum amount figure. So it doesn't mean that you have to buy a house at 1.15 million, but it does give you the ability to go that high.
And quite often what we're doing as mortgage professionals these days is, as a client is coming to us, we are no longer just pre-qualifying them for the blue lender. We are trying to advance them all the figures with the different scenarios ahead of time. So in case that you are a client that is looking for a solution and wondering, hey, can we qualify for all of these different types of lending solutions? Give us a shout. We can work with you over private message and look at your different solutions and pre-qualify you among all these solutions. Obviously, what Sam is saying is true. You may not want to extend yourself to the max. These are just max numbers. It's always a good thing to take a look at your budget and see where you stand personally as to how much of your own income you are willing to put towards housing costs, and look at your budget on that basis. But wow, Sam, that was quite an increase in borrowing power for those who do want to extend themselves a little bit further.
Yeah, exactly. I mean, there are solutions that are out there. I know that, obviously at the max case where you're paying additional rates and additional fees, it may seem a bit extravagant for some prospective home buyers. But even from going the blue bank to the green bank, an increase of about 10% can take you from a position where you're out of the market to, where you're in market for relatively fair compensation when you look at the rate in comparison to today's best rate. So I think we covered some good information on some possible solutions for you if you're still looking to get into that market, and you're seeing January stats and maybe you want to be somebody who's getting 22% appreciation every year. So it's definitely, looking into some extended borrowing ratios can definitely help you into the market.
Exactly, Sam. Thanks for those comments today, and great episode. I think it was really shedding a lot of light today on just how crazy this market is getting, and also what really extended borrowing solutions that are available out there to make that happen for our clients. So definitely get in touch with us if you would like to talk about those solutions. And as we look into next week, we just wanted to take a moment and introduce our episode. But before we do, I wanted to take a moment and introduce Sam. Sam Thompson is a mortgage agent here with us at Verico Lend at Ease. And he is been with us for almost 2 years now. I think we're just about hitting that right now.
That's right.
And originally moved from Ottawa and living here in Barrie with his wife and pup. Great to have you on the show today, and thank you for presenting all these great figures and facts that you brought today.
Yeah, of course. Thanks for the introduction and for having me on today's episode. The traffic's much better in Barrie than it is in Ottawa with all those semis. But yeah, definitely happy to be here. And thanks for joining us, Joe. It's always great to have your input and expertise on our show. For anyone who doesn't know, Joe's been in the industry for over 11 years now. And brings a lot to the table in passion and just, again, market stats and information, living up in Aurelia with his wife and 2 kids. Thanks so much for joining us today, Joe.
Thank you very much, Sam. And join us next week for the episode where we'll be talking about how Canada's first-time homebuyer is officially dead, and how to really look at some other options available, such as perhaps leveraging with other homeowners and trying to get in the market in other ways. We'll talk about that all here on Canadian Mortgage Weekly. Join us for episode 64. And thanks for watching, and hope you have a great day. Don't forget to like, follow, and comment and share.